Okay, everyone. Welcome to week 4. So today's schedule is the following. We're going to go over last week's quiz review, and then I'll go over the first 2 questions of the ungraded problem set. So the last question, I leave it up to you to kind of look through the data yourself and convince yourself that indeed the covered interest rate parity is more or less satisfied over time, whereas UIP, there's lots of volatility and fluctuations, but it does hover around 0. The carry trader's expected profits hovers around 0. All right, so today's topic is something that's hopefully review for most of you. So we're probably going to we'll spend some time talking about multivariable calculus at the end of today's lecture, but it's certainly not necessary to comprehend like the intuition. So today's class, we're going over part of the so-called ISLM model. So this is from your macroeconomics course that hopefully many of you have taken. But if not, it's not necessary to know because I'll just go over it very slowly. So we're basically combining the LM part of the ISLM model with the UIP model that we have today. So as you recall, the LM part stands for liquidity money, money demand. And so what we're doing is try to interlink interest rates with the money market in which money supply and money demand clears. All right, so that's our goal today, is to go over the liquidity money model, part of the ISLM, and then see where it fits in our UIP, or uncovered interest rate model that we went over last week. All right, so let's go over the quiz first from last week. So last week's quiz, more or less, I think there's about 200 of you, okay, total from this section and the afternoon section. So about 100 of you got full score, okay. So that's very good news. But the other half, around some got 2 out of 3, some got 1 out of 3, and some got 0 out of 3. So there's still some, misunderstanding of some concepts. So if you're struggling with something in this class, you have to let me know, and I'm happy to go over it either during class or after class or during private office hours. All right, so let's go over the first quiz question. So the spot rate for CNY stands for Chinese yuan per Canadian dollar, CAD, is 6.444. If the Canadian interest rate is 2.5% per annum and the Chinese interest rate is 3% per annum, the 3-month no arbitrage forward rate is closest to what? All right, so just based on the setup of this question, the first thing you should do is identify the domestic and the foreign currency. So just based on the quote I gave you, right, CNY per US CAD, CAD is in the denominator. Therefore, CAD is the foreign currency. The Canadian dollar is the foreign currency. Chinese yuan, on the other hand, is therefore the quote currency, the numerator. And so once you establish what is the foreign and what is the domestic currency, you can easily assign R and R star. Then you just apply CIP or UIP. You know exactly what to solve for. So in the setting, we have E equals 6.444, right? And, 6.444. And based on our definition of our currency quote, we know that Canadian dollars, or Canada, is the foreign country, and therefore R star is the 2.5%, and we divide by 4 because we're dealing with 3-month forward contracts, right? So 3 months is a quarter, right? 3 months of a year, and therefore we divide by 4. Once we establish what R star is, we know what R is the domestic currency. Domestic currency is the Chinese yuan, and therefore R for just a quarter of a year is 3% divided by 4. And just plug those numbers into CIP, right? This is what this second bullet point is. And you solve for F, right? Very simple. And you should get a number that's close to this, 6.452, and you'll see that it's in fact C. Okay, so I think majority of the people got it, but some maybe they got confused between these last two digits and chose the wrong answer. Okay. All right, comments, questions on quiz question 1. So this is like a very typical question I could ask on the midterm, right? Very easy. Again, the hard part is the first step, which is identifying which currency is the foreign currency, which currency is the domestic currency. Once you establish that, you know exactly what R and R star is. Once you know what R and R star is, you just apply the formula. And you could identify the no arbitrage forward price. All right, question 2, again, building on the same procedure in which you solved question 1, asks the following. If no arbitrage forward price rate for euro in Japanese yen is less than the spot rate, then the interest rate in A, Japanese is the same as the Eurozone, B, Japan is less than in the Eurozone, or C, the Eurozone is less than in Japan. So step 1, again, identify the domestic currency, identify the foreign currency. So if you just based on this sentence here, right, forward exchange rate for a euro in Japanese yen. So euro is the denominator, therefore euro is the foreign currency. And JPY, so JPY or Japanese yen is the numerator. And as a result, it's the domestic currency. Once we establish which currency is the foreign or domestic, we can therefore figure out which ones are in R star, right? So R star is euro, and R is Japan deposit rates, right? And we know from class that we can approximate the relationship, the UIP, or the CIP relationship with the following expression. And given that F is less than E, right, as stated here, is less than the spot rate, we know that this entire expression here is negative, right? And therefore, the right-hand side also must be negative. And it's negative. It's being negative implies that domestic deposit rates must be less than foreign deposit rates. Okay, so how do you translate that to English? Well, it just means B, right? Japan's interest rates is less than the Eurozone's interest rates. Okay, so this is again just translating English to math and then translating the math back to English. That's it. I think that's the hard part. Comments, questions on quiz question 2? All right. So I hope everyone's just in when they see this question, it's automatic. Identify the foreign, identify the domestic currency, figure out which country is the foreign country, which country is the domestic country, apply CIP, outline an arbitrage strategy, and that's it, right? And then you know which formula to use, which numbers go to which parameter, and you can outline easily an arbitrage strategy if I ask you to, and yeah, that's it, right? All right, question 3. The carry trade is most likely to be profitable when A, uncovered interest rate parity holds, B, the Fisher relation is violated, or C, the forward rate is biased estimator of the future spot rate. All right, so let's just go over each of these options one by one. So the uncovered interest rate parity holds. So we all know from last week's lecture that if the uncovered interest rate parity, and also its additional assumptions, right? That means that on average, carry traders cannot make a profit by going long and going short on interest rates. Yes? So just by definition, this is not a very good answer, right? So A is not, it can be safely eliminated. B is something that's totally irrelevant to the question. So if you took macro, you know what the Fisher relation is. If not, we will cover it in the next few weeks. All right, but you could easily Google this. So again, when you do the quizzes, I don't mind that you guys talk to each other or go online, okay? So you can easily Google this and you realize, it's just a decomposition of nominal interest rates into its real component and its inflation component, right here. And this really has nothing to do with UIP. All right, so you can also safely eliminate B if you know that. All right, so just by process of elimination, C is the best answer. And you can, if you read it, it's also you can also convince yourself that it's true. So it states that the forward rate is a biased estimator of the future spot rate. If you believe the forward market is a market on like a betting market in which people kind of reveal their expectations of what the spot exchange rate should be, then F should be a good approximation of future spot exchange rate, and therefore UIP should be unprofitable. But if F is not accurate, it's not a good measure of future expected spot rate, then of course UIP will be violated. You just can't see it, right? And carry traders obviously could theoretically make positive expected profits. Okay, so to emphasize here, the mechanisms that allow CIP to restore parity is not exactly the same as the mechanism for UIP. So CIP only relies on one assumption, which is there's no arbitrage possible. If there is arbitrage possible, then arbitrageurs will come in and make risk-free profits, right? It's just free. It's a money machine. They just make free money out of nowhere until it's fully exploited and the parity must be restored. UIP, on the other hand, requires more assumptions about how investors behave, namely about their risk preference. We have to assume that the only characteristic of returns that investors care about is its mean return. And every other features of risk that you can imagine, like variance, skewness, kurtosis, all these statistical characteristics of risk you learned in your hopefully stats class, they don't care. This investor doesn't care. Based on this model of an investor, that's the only way UIP can be restored, right? Because they are maximizing expected profits, and when they see expected or average profits that's greater than 0, when they do go long and go short on interest rates, different interest rates, they will come in and buy or sell currencies and restore UIP. Okay. So buying and selling currency, yes, that mechanism is the same between CIP and UIP, but the incentives are different, right? One is deterministic, right? There's literally free money on the table, and you just come in and you can get it. On the other hand, UIP, you have to believe that investors maximize expected returns, right? Not free money, but average free money, essentially. All right, comments, questions on a quiz? All right, cool. So we'll have another quiz today, but it's not about today's topics is not about interest rates so much. It's more about monetary policy and banking. Okay, so we'll talk about that, and these questions most likely I hope everyone will get because you've taken some form of macro or banking in other courses. All right. So let's go over the ungraded problem. The first two questions of the ungraded problem set 3. So the problem sets this week was just again just a review of the difference between CIP and UIP, and just test if you understand the assumptions and how to basically plug in numbers into the formula, and also to investigate with real data, which I provide for you on Canvas, to determine whether or not CIP or UIP really holds in reality. So the first question is very simple. Just state the assumptions of each of these models. So CIP, you just state the equation, and they ask you to tell me what are the assumptions for it to hold. The only requirement for CIP to hold is that there's no arbitrage. If there is arbitrage, people will come in and maximally exploit until there's literally no money on the table. Very, very simple model. Okay. And if you investigate this with real data, you will see that it is in fact true, more or less. Okay, very, very basically 0 expected profits. Okay, UIP on the other hand is different, and the difference comes from this parameter here, right? We have to make some assumptions in which we can swap out the forward rate for the expected future spot rate, E hat E. And we rely on two assumptions, right? We need perfect efficient markets, meaning that there's very little transaction costs, as well as perfect information or symmetric information. Markets can aggregate information, and therefore you can rely on the markets to kind of forecast the future spot rate. Another way of saying this is that there's no risk premium. So meaning that E fully captures all sources of risk, So when I say default risk and all these other these kind of sources of risk, that's all factored into E hat E. If it's not, then we need to make certain adjustments to the model, which we will do, in fact, in a several weeks later, definitely after the midterm. But that's the idea. Okay, so if you're not comfortable with this perfect market assumption or explanation, then you can just think of it from a finance perspective. No additional risk premium that's not omitted from the model. That means E captures literally every source of risk, and the market, it reflects that. The second assumption is risk-neutral investors. So the market efficiency allows us to swap F for E hat E, and the risk-neutral investors allows us to restore parity. Okay, so whenever UIP is violated, there's going to be investors that come in and will want to maximize expected profits, carry trade profits, by going long and going short on certain currencies, and make that profit that they expect will be positive. Okay, so the second question of the ungraded problem set is just asking you to plug in numbers into the UIP formula. So rather than read the prompt, it's going to tell you what the prompt assigns for these values. So R star is equal to 5%. For the first part, they just assume that two countries have this identical interest rates, and to solve for what the expected future spot rate should be equal to. So this is a very easy exercise. So you just plug in 5%. Dividing by 4 is kind of unnecessary, even though we're talking about, I believe, quarterly periodic returns. Everything cancels out other than E hat E minus E equal to 0, right? You just add E to both sides, and you'll realize E hat E is equal to E. And we talked a little bit about this a few weeks ago in the case of like currency with pegged exchange rates, right? So think about Hong Kong, right? Hong Kong is more or less a pegged exchange rate. You can think of it roughly as a pegged exchange rate. If it's a pegged exchange rate, it means that the Central Bank of Hong Kong, which is called the HKMA, the Hong Kong Monetary Authority, has no plans to depeg or change the exchange rate sometime in the future. If that's the case, then obviously at any time horizon, E hat E must be equal to E. And therefore, interest rates in Hong Kong must move in parallel with the United States. This must be true if they were to maintain a pegged exchange rate. You can see this in Hong Kong. I'm trying to think of any other country that has pegged currencies. I mentioned maybe last week that Mexico at some point in time for 10 years had a pegged exchange rate to the US dollar. So there are certainly still some countries with pegged exchange rates to vehicle currencies like the US dollar. All right, so that's kind of the intuition that I think this question was pushing with this identical interest rates. Okay, so again, the punchline here is that when you have a currency, if you have a country that pegs its currency to another currency at a fixed exchange rate, its interest rates must move together, more or less. All right, so the second part of this question gives you different numbers for its interest rates. So it gives you R equals 5% and R star equals 10%. And also it says that E hat E is also equal to 1.5. So just given these assignment of values, you just put those numbers into UIP and just solve for E in this case. Okay, that's the only missing parameter here. So I won't go through the description of how to solve, but once you rearrange the formula and you put everything on one side and E on the left-hand side, you should get a value of around 1.51. Okay, so and then the third problem set, 3.3, ungraded problem set 3.3, it's on Canvas. So just take a look at the data set yourself. Look at the time series of foreign currency returns, and look at each cell in the formula, how I actually, expressed expected profits or actually realized profits if you conduct carry trade or arbitrage, right? And you can see whether or not UIP or CIP is violated over time. You should investigate this and convince yourself that CIP is definitely holds, okay? More or less no free cash on the table, but UIP, if there's wide fluctuations. Despite hovering around expected profits around carry trade profits around zero, there is wild swings. And today we're going to try to come up with a model to explain why there is such wild swings in UIP. Yeah.
Looking at UIP and CIP and E hat E versus the forward rate, will E hat E theoretically be equal to the forward rate? Because the forward rate is just the expected entry. Is there a relationship between the two?
So F is in a perfect world. Yes, you're right. It should be the same. This is called the unbiasedness hypothesis, which I mentioned a few weeks ago. But certainly people have different information sets. And obviously there could be, we don't observe, first of all, we do not observe E hat E. We have no idea what that is. This is something that's, we can only guess from the forward markets. If you decide to rely on forward markets to kind of gauge the direction of where E should go. Yes, so in a perfect market with no transaction costs, no asymmetric information, everyone has the same information sets. On average, F should be equal to E hat E. Yes, but we have no idea. We have no idea what E hat E is, and we rely basically either on the forward prices or surveys, which is what most people do. So banks usually conduct surveys with other banks, and they can kind of get an idea of where foreign currencies can go. But yes, I hope I answered your question. So yes, in perfect markets, F should be equal E hat E. But it's not, because well, first of all, it's hard. We can't test it. Not testable. Okay, so good question. Yeah, so in finance and economics, we have to make a lot of assumptions to get things to work. And that's just the reality of things. This is the so-called art side of economics and the less scientific. But we like to add mathematical rigor in our forecasts. And so this is the whole point of this class, is to kind of add structure to intuition so that we can make reliable, hopefully, logic-based forecasts of where things should go, particularly in this case, in this class, foreign currency returns. Okay? All right, comments, questions on last week's contents or the ungraded quiz, problem sets or the quiz? Okay, so yeah, so if this scares you, don't worry. Okay, so today's lecture I won't talk about multivariable calculus until the end of class for those of you who want kind of the rigor, and I will explain to you why the graphs I have certain shapes the way they are, and for those of you who demand it, it's going to be there. Okay, so today we're going to basically cover central banking and how central banks go into the market and conduct so-called open market operations to change money supply and how that impacts interest rates. Okay. So I hope this is all review. What's the relationship between bond yields and bond prices? We will very, very briefly touch on that. And then in step 3, we're going to try to connect this so-called money market, because we're talking about money supply and money demand, with UIP. So we're going to combine two markets, the Forex markets as expressed by UIP, with the money market, which relies on the market clearing condition that establishes an equilibrium interest rate. So you hopefully can kind of see how two graphs might combine together. All right, and then we're going to conduct some comparative statics and analysis. So we're going to kind of do two types of analysis. We're going to think about what it means to make short-term and long-term forecasts on the impact of monetary policy on FX rates. So we're going to kind of be very specific what we mean by short-term and long-term. In this case, we're talking about prices, whether or not prices will react immediately to changes in money supply. That's what we mean by short and long-term. Okay, again, this is just a look ahead, just to give you a brief overview. Step 4, we will Yeah, so step 4, I believe I'll combine the two models. And step 5, we're going to, again, add another layer of analysis in which we compare so-called temporary and permanent changes to money supply, or temporary versus permanent changes in monetary policy. And this is going to be reflected in our E hat E. So what sort of monetary policy will have an impact on E hat E, and what sort of monetary policy won't have an effect on E hat E. So as you can imagine, something that's temporary won't be very long-lasting and most likely won't have an impact on our future expectations. Temporary meaning that a certain policy will be reversed. So if a central bank wants to go in and buy or sell certain assets, that policy will reverse itself before we reach the future in which E hat E matters. Okay? So that's what we mean by temporary. Permanent means an action that's indefinite and won't change beyond the time horizon of E hat E. Okay, so right now might be a little bit confusing, but that's where we're going. Okay, so to summarize, we'll talk about central banks, what the balance sheet looks like when they change money supply, how that results in market clearing to establish interest rates, and then we're going to conduct two types of analysis: short-term versus long-term effects of open market operations, and temporary versus permanent changes in monetary policy through open market operations. All right, so our, again, objective: combine the model for money and foreign exchange rate markets. And we're going to connect interest rates with E. And I will do it through math, and I will do it also through the graphs. And I believe the graphs is probably most intuitive, but of course, understanding the math, how parameters change and how changes in parameters will affect other UIP, for example, is important as well. Okay? And in this class, in today's lecture, we're just going to assume that UIP is always satisfied. Okay? If there's any sort of distortion because of the change in R, for example, UIP will restore itself somehow, right, through carry traders and so forth. All right. So to review, again, usually when we review banking, we like to review what money really is. So I think you've all seen this somewhere in your macro classes. What's money? It's a medium of exchange. That means you can use money to buy goods and services. It's a unit of account, meaning that you can compare values between certain goods and services. That's how you get, debt. That's how you're able to value debt contracts and compare certain debt contracts to cash, for example. And it's also a store of value, meaning that the value doesn't really fluctuate over time. So these are the three basic functions of money. And I think one of the misconceptions most people imagine is like central banks just create money out of thin air. So that's kind of a misconception. It's not literally out of thin air. What the central bank is actually doing, if you want to think it from a credit standpoint, which I mentioned in the first week of class, issuing money is just issuing debt. Okay? So whenever a central bank issues currency, it's actually, what it's really doing is basically refinancing itself. It's like giving himself a loan. Okay? So for central banks, when they, for example, they go into the market and they buy U.S. Treasuries. U.S. Treasuries is the U.S. government debt. They're actually swapping one debt for another debt. So this action, if you want to think about it, is like refinancing. It's as if I issue my own currency to just give myself a loan. I just go use my currency to buy stuff. It's the same thing. Okay. So it's not out of thin air. Okay. But what's unique about money issuance is that only central banks are able to do this. They can give themselves a loan, refinance themselves, and go out and buy things. Central bank are the only institutions in the world that can do this. And they, as you can imagine, they can make a lot of money from doing this. And in fact, the U.S. Central Bank, the Federal Reserve, has made tons of money from doing this from the 2008-2009 financial crisis. Okay? Okay. Another institutional detail. The central bank is separate from the Treasury. Okay? I don't know what the Treasury is called in other countries. So usually the institution that auctions off debt is separate from the central bank. The central bank's job is solely to control interest rates. Okay? The primary function of central banks is to control interest rates. Debt issuance, on the other hand, is a separate institution. Okay, so the central banks, therefore, are usually thought of as quasi-private institutions. While they are required to report to the government and so forth, they function more or less like a hedge fund. Okay, they do a lot of asset purchases, asset sales, and then they have a portfolio, but they're doing this to manipulate interest rates. Okay, that's the role of the central bank. It's not to retire debt, issue debt, none of that. They do go in and buy debt, they do sell debt, but it's for a particular purpose, right? It's not to, it's not to generate money for the U.S. It's to control interest rates. So again, misconception is when they go out and buy debt, it doesn't mean that the debt disappears from existence. It's on the balance sheet. It's on their balance sheet. Okay. All right. All right. So money is an asset. Right? It's an asset for other people. Right? They go in, they buy certain assets, but in exchange for currency, and that currency is an asset. Because it's their debt, right? It's the U.S. government's debt. The return, as we mentioned earlier, the return is basically the deposit rate or the interest rate that's set by banks, and the return is small. The risk is, we usually assume that money's risk is basically nothing, right? There should be no risk. The only source of risk that you can think of should be like inflation risk. And it's very, very liquid typically. So it's easy to convert your currencies usually, okay? Particularly US dollars. Some currencies under certain circumstances like hyperinflation will have liquidity problems, right? Then money is less of an asset and more of a, something you want to throw away, okay? Okay, so how do we determine the opportunity cost of money? Well, we look at the next best alternative investment, right? The next best alternative investment, as I kind of mentioned earlier, is some sort of longer maturity debt, right? So that's what bond yields represent are. So if we change interest rates or bond returns, we essentially change the opportunity cost of holding onto money. So opportunity cost, again, means your next best alternative investment than holding onto cash. Right. There are many reasons why you want to hold on to cash. You might want to hold on to cash because you want to buy stocks because you think they're going to go up in value. You might hold on to cash because you want to buy something in the short run, right? But when interest rates go up, then the likelihood of your returns on buying that stock or your returns on consuming that thing today goes up, right? It costs more because you're missing out on the higher interest rate. Okay? So when we think about money demand, right? Changes in money demand, it comes directly from the opportunity cost set by the central banks, right? They change money supply, they change interest rates, and those changes in interest rates will change your opportunity costs or economic costs of holding onto cash today, right? It doesn't matter if you're using the cash to make investments for buying stocks or buying goods. Once interest rates go up, your cost of doing that original action also increases, right? Because you're missing out on those interest rates, the higher interest rates. Okay? And the argument is exactly the opposite when you go the other direction, right? When interest rates go down, my opportunity costs go down, my next best alternative is not so good, so I might as well just go out or buy that handbag or buy that car or buy the stocks, because the stocks on expected returns will be higher, right? So let me write some notes here to emphasize what I just said. So if we have an increase in R, the intuition here is if you increase R, it's going to increase opportunity cost. Opportunity cost in more normal speak means that your next best investment, your next best action. Your next best action will obviously increase if interest rate increases, if you're planning on holding on to cash to do something with it. And as a result, that's going to decrease money demand. Right? So this is ultimately the key mechanism in which central banks control interest rates and also money demand. Okay, so you can already imagine that there should be a negative relationship between R and money demand. As you increase R, increase opportunity costs, decrease money demand, right? If you decrease R, lower opportunity costs, increase money demand. Yes, that's the intuition here. All right, comments, questions on interest rates and how that's related to money demand? So again, to summarize. In order to change households' willingness to hold on to cash, you have to change a household's next best alternative action or investment in this case. And you can do this by if you look at cash. Cash is very liquid. It earns very low interest rate. So the next best asset after cash is something to be something that's probably not very risky, right? Something that's relatively safe, but also but something that has more or less similar returns, right? And that something is probably, as you can imagine, government debt, right? Bonds, essentially. So what central banks can do is they can change bond yields, right? And therefore change interest rates. And they can do this by changing the supply of bonds in the market. And we'll talk about this, how they do this. But that's kind of the idea. They change the supply in the market for bonds, which will impact prices, impact bond yields, change interest rates, and therefore change money demand in the economy. And the key mechanism, again, here is that we're changing the opportunity cost of holding on to cash. So lately, I know, for example, I don't know if people are making investments here or have a bank account. I hope you do. Interest rates have been rising recently, and maybe you guys have been thinking about, maybe I should put my money in a certificate deposit for 4%, right? Some of you might have been thinking about doing that already. So hopefully you believe this mechanism that I just described. All right, so other tools that central banks can use to kind of curtail or relax money demand is reserve ratios. Yes, so the last bullet point here. So reserve ratios, maybe I can describe kind of like the money multiplier effect first. So I hope everyone here has heard what the money multiplier is. It's when, for example, someone with, for example, $1,000 deposit that in a bank. The bank then takes the $1,000 and lends it out, and that can kind of go on forever, right? So in order to kind of restrict the growth in money creation in this manner, the central bank can tell its banks that it monitors to actually keep a fraction of that cash on reserve. Like they're not allowed to move it. Okay, that's how you kind of curtail the infinite growth of money. Okay, they can set these reserve ratios for these retail banks, commercial banks, and that prevents the money from growing too fast. All right, so we won't talk about so much the reserve ratios in this class. So let me just mention here. Increase reserve ratios. This will also decrease money in circulation. So our primary tools that we want to focus on is this. Okay, this one. These are large-scale transactions that's conducted by central banks at certain exchanges. So in the US, it's conducted in New York City. by the New York branch of the Federal Reserve. I don't know about PBOC or HKMA, but I imagine HKMA just does it in-house. PBOC, I don't know where it's done. You have to look it up. But I imagine it's the same mechanism. Okay. All right. So let me clarify that when we talk about money supply, we're talking about all aggregates of money. Okay, so you can decompose that into several categories. So maybe I'll just outline as a review what these categories are, just to give you an idea of what money supply subsumes. Okay. So M0 is monetary base plus bank reserves. Bless you. M1 is M0 plus deposits. M2 is M1 plus savings. And M3 is M2 plus time deposits. I won't test you on this, but just to give you an idea what money supply encompasses. Okay. All right, so let's talk about OMO. So I will use the abbreviation OMO to stand for open market operations or transactions. And this involves buying and selling assets, namely government securities, government issued bonds. Okay. So this is what we're going to kind of look at now. How does the central bank's balance sheet change when there is a monetary so-called contraction, a sale of an asset, or expansion, the purchase of an asset? All right, so just to preface this explanation, this is not related to accounting as far as so if you know any accounting rules, just keep them separate. Okay, so I am not an accountant either, so I can't tell you if it's the same as the accounting rules that you learn in your accounting class. But this is how economists think about open market operations from a balance sheet point of view. So let's look at a balance sheet. So what is a balance sheet? There's two sides of a balance sheet. There's an asset side. Okay, that's just, you can think of it as cash inflow, just assets that you hold that you receive money from, and also a liability side, which is something you have to pay out, or something that you have to redeem if somebody brings their money to you and you have to redeem. So I'm going to arbitrarily draw some lines here, kind of just to tell you how much value each of these are. So a typical central bank's balance sheet essentially has, I guess, three components if you want to put them in categories. They have foreign assets, which I'll usually denote using W. CB stands for central bank. So W I use for foreign assets, B for domestic assets, and other assets, gold, and SDRs. SDRs are special drawing rights, which is more or less a international currency that's, I guess, set by IMF. Okay, so you can think of it as a universal currency, but it's just something that's benchmarked to a basket of currencies. We won't talk about this so much, okay, other assets. We'll basically talk about foreign and domestic assets on a central bank's balance sheet. The liability side, obviously, as I said, it's money supply, monetary base. That's the issuance of debt, right? So when you issue debt, you have to pay out, right? And as a result, it's going to be on the liability side of a balance sheet. Now, this part, net worth, is if you decide to, mark to market all these assets. So the difference between the asset value and the liability side is called net worth. So assets minus liabilities. And yes, so given this part here, then you should conclude that yes, assets and liabilities should balance each other out, right? They should be the same. Okay, let me write SDR here in case people ask me later. So SDR equals special drawing rights, which is a claim to currency held by IMF, and it's IMF, which is approximately a quasi-global currency. In case you were wondering, okay, but this we're not going to talk so much about it, but in case you were wondering. All right. So comments, questions on this setup of the balance sheet. So we're kind of going to, for this class, we're just going to ignore this, and we're also going to ignore this. And so when we think about changes in the balance sheet, we're just going to be working in a very simple structure. Okay, so we just have foreign assets, domestic assets, and then monetary base. And let's just assume, for simplicity, that net worth is just equal to 0, and we're just going to have a balanced balance sheet. Okay, assets equals liabilities. All right, and so in this example slide, I ask the following. I ask, what happens when we increase the monetary base? All right, so as I told you, you can't just print money out of so-called thin air. That's kind of a, again, misconception. It has to be used for something, right? So in this case, you can think of it as refinancing itself. So it has to swap one sort of debt for another debt. So let's just think about the US Federal Reserve deciding to issue cash so that they can buy up some of US government debt. So when they print so-called print money, what happens to the liability side? It has to increase. Yes, it has to go up. And when they make the purchase, right, then the asset side of its balance sheet also has to go up as well. So in this case, BCB has increased, right? Let's just say increased to here. And also monetary base increased. So increase in BCB, and also increase in MS. So this is the so-called printing money, but again, it's not really printing money because you're swapping debt, right? You're swapping one sort of debt for another debt, for another, yeah. So printing money. Printing money to buy assets. So just to clarify, central banks do not necessarily have to buy the government-issued debt. That's just the prototypical example that we use to explain how the balance sheet expands and contracts. Okay, so like terminology here. So sorry for so many tangents. So when we increase MS, we typically have a term for that that's called monetary expansion. When we decrease MS, that means monetary contraction. So you can do the same exercise in the reverse, right? If you want to reduce the money supply, you can do this by selling some of domestic assets. So there's a contraction, right? You have this entire balance sheet being reduced. And once you sell these assets, right, you're actually reducing the money supply that you have into the economy, right? So let me explain the mechanisms. Monetary expansion. You print money to buy assets. So whenever you print money, you're injecting literally liquidity into the system, into the economy. Result, inject liquidity into economy. Right. So the idea is the following, okay? Why does it increase liquidity? Well, once you buy the asset, the banks now have more money to make investments. When the banks have more money, they will start to look for positive expected returns somewhere else, right? Beyond government debt. Okay, if they sold their debt, they're going to have more cash. They can use that cash to buy other assets, make more investments, and that's kind of how it so-called trickles down into the other economy, spillovers into the other economy. Now, if once you want to curtail the speed of money supply because the economy is growing too fast, well, you can do the opposite. Rather than print money, you can think of it as burning money. Okay, so how do you do that? Well, you go into the open markets, and instead of buying assets, you decide to sell things on your balance sheet. Once you sell the asset, you're exchanging the asset for cash, right? So then the cash money supply, therefore, it's like you can retire cash. And so your liability side will shrink as a result once you sell the asset on your balance sheet. Yeah.
So essentially when you sell those assets, that money doesn't exist anymore?
Yes. It's no longer in circulation in the economy. Yeah. Again, just think about it as refinancing, right? So if I can issue my own currency to buy my own debt and then reverse itself, then it's like the same thing. So that initial issuance of cash no longer is in the system anymore. Okay. Any other comments, questions? So banks lend the money to stimulate the economy. Okay, and then the opposite for the other direction. Yes.
Usually, who do they sell those assets?
Primary dealers. Okay. There is a consortium of banks in every country that basically handles all auctions on behalf of other financial institutions. In the US, that's a group called the primary dealers, which includes like JP Morgan, Goldman Sachs, and all these big bulge bracket banks, as well as international banks like Nomura. These people handle all the so-called requests to buy or sell certain securities. Okay, they're the ones. Yeah. So you can't, as a retail investor, you cannot participate in these asset purchases. You have to go to these dealers to do it. Okay, that's how it usually works. Yeah. Questions? Any more questions? Oh, yeah. Yeah.
Do open market interventions only work for the secondary market, or can the central bank also buy newly issued debt?
Oh, the secondary market. Yeah, it's a secondary market. So when they do this, it's all in the secondary market. So yes, another okay. Institutional detail. So someone mentioned secondary market versus primary market. So primary market, just like stocks and bonds, there's an initial issuance of stock, right? That's like the primary market, IPOs, and there's a secondary market, which is the stock market. We have the same thing for government debt. Primary market is the auctions, when debt is auctioned instead of that's their version of initial public offering. It's an auction of debt. That's the primary market, and I do not believe the Fed participates in the primary auction. I mean the primary market, because it's like lending to yourself. Yeah. Usually the Treasury Department in the U.S. is the institution that handles the primary market. The secondary market is handled by, I believe, the Federal Reserve branch in New York, and they're the ones that handles the transactions there. Okay, so yes, so yeah, these expansions and contractions all done in the secondary market. To answer your question, okay. But just a little background on how bonds are issued and so forth. Okay? Good questions. Not a lot of people ask me about these institutional details. So, all right. So now you kind of understand the mechanism. Now let's just apply. Let's apply the mathematical rigor to formulate these intuitive relationships between interest rates / opportunity costs of holding on to money and liquidity or money demand. This equation, you must have seen it, I hope. This is the real money supply equation from your ISLM model. OK, let me explain to you what each of these variables mean. So MD stands for real money demand. That literally is just like an aggregate sum of total cash demanded by the economy. P is an average price level of an economy. So you can think of it as CPI. L is the liquidity demand preference, so-called liquidity preference function, and it takes two parameters. It takes R for bond yield or interest rates, and Y for aggregate output of an economy. So as you can imagine, as you can see already, when we try to link our Forex market to the real economy, it's going to be done through Y. But for now, we're just going to assume that Y is just an external, a parameter that's held constant or changed arbitrarily. Okay, it's not a function of anything else. So you can think of L as like a real quantity of goods and services demanded by an economy, right? Think of liquidity preference as like an average unit of goods and services demanded by a country. Multiply that average units or number of units demanded by a country times average prices. That should give you total quantity money demanded, right? P times quantity gives you total money. Yes? That's the kind of intuition we're heading. But in macro, we like to work with real goods, real supply, real prices, so-called real quantities. And that just means we scale everything by prices. So if we just divide prices by both sides, then what we have is real money demand equal to liquidity preference. So far, so good? Not, I hope it's, if no macro background, I hope at least the math is simple. So again, intuition. Just intuition is more important than the math, okay? Based on this equation, we're trying to characterize total money supply demanded by an economy. That is represented in two ways, right? Price levels and average quantity of goods and services demanded in a fixed period of time. Let's just say within a year. This quantity function, L, has a name. We call it liquidity preference. It takes two parameters. One, interest rates, and the other is aggregate output. You can think of it as income. Okay, so income. Why is income? So output meaning that anything you sell, you get some money, and that amount of money should obviously affect your liquidity preference or liquidity demand for cash today. Intuition why R matters. R is the opportunity cost of holding onto cash. If opportunity cost increases for holding onto cash, then you most likely will hold less of it, and some people will convert cash to debt-like securities that pay interest. So R, therefore, should have a negative relationship with liquidity preference or money demand. Why does output matter? Well, output is a representation of income. If income changes, you can imagine many people will spend more money on goods and services. So just based on this characterization with two parameters, we can already establish a relationship between L and R and L and Y, right? R has a negative relationship with L, and Y has a positive relationship. So let's put a minus sign here. Maybe I'll just draw it. You have a minus sign here and a plus sign. All right, so for those of you who are mathematically inclined, what do these characterization means? These symbols mean, it means that if I take the derivative of L with respect to R, that derivative is going to be negative, holding all other variables constant. Yes? What does this positive sign mean? It means that if I take the derivative of L with respect to Y, that derivative is positive. Just characterizing the relationship between two parameters, right? That's what a derivative is. So let me again summarize the mechanisms, or sorry, the relationships in this model. So L is negative related to R, higher opportunity cost, less money you want to hold. L is positive related to R. Higher income means you can consume more today, which means increase money holding.
Do you mean all is positively related to Y?
Oh, yes. Correct. Sorry. To Y. Yeah. Let me draw this more clearly. Positive and negative. Okay. So maybe I will write this as well, in case people prefer the math. What I mean is dl, dr is negative, and dl, dy is positive. If you don't know what this means, don't worry, okay? As long as you understand this, it's enough, okay? All right, comments, questions on the real money demand equation from your macro class? All right, so more review. Before we actually start drawing things, let's review bond yields. I hope this is not hard to read, but bond yields all bond yields have a corresponding price, okay? And actually the price is determined by the markets, and the yield is calculated afterwards, typically. And so as you will see with this really simple example, there's a negative relationship between prices and yields for bonds. And I can show you this here. So let's think about a situation where you have a bond that that's actually priced at a 20% discount. Okay, so what does that mean? So bonds have certain terminology. So let me start with the terminology first. Principal. I hope everyone knows what that is. Principal is the amount of money you get after the bond expires. But at the end of the expiry, you also get some interest rate. Correct? That's the so-called discount rate. All right. That's this R here, right? So in this equation, think of a bond that's priced at 0.8 that pays $1 or $1 million in 1 year, and that's called the par value or the principal. Okay? If you want, how is this price determined? Well, it's actually discounted using the interest rate. Okay, and you can solve for this interest rate given the prices, right, very easily in this very simple 1 year example. Multiply both sides by 1 plus r, right, and rearrange some terms, and you can solve for r directly, and that's 0.25. And just based on this equation here, you can see that if I increase r, that's going to increase the denominator, and as a result, decrease this entire expression, right? And as a result, prices will decline subsequently if there's an increase in r. So just based on this simple example, it should be very clear to you that bond prices and bond yields are negatively associated. All right. So I believe, so I wrote face value, par value, principal. It's the same thing. Okay. It's the amount of money you get at the end of the term. That's the loan that's given out, right? The loan value. When we say that a bond that has a 20% discount, that means the price is discounted. Okay. So in this example, we have a very, very simple bond. This is basically like a T-bill, right? T-bills don't pay coupon payments. They just have a simple return structure like here, just one period. In this case, we have a 1 period return of a bond, but it has a price today at a discount. It's discounted because we have the discount at this so-called bond yield or interest rate. Based on this formulation, it should be easy to see that bond prices, right, it moves in the opposite direction of bond yields. So whenever central banks go into the open market and buys bonds, right, that's going to do what to the price? Go up, yes? It's going to increase. When bond prices increase, what should you expect of bond yields? Yes, go down. That's right. So just based on this simple math, I hope everyone can see how OMO, open market operations, impacts bond prices. Yeah. So the question you may be asking is, well, does the central bank buy like all bonds across all maturities, or does it buy just one single bond? Well, that's a hard question that every macroeconomist has been studying since, early 2000s. So I don't have the answer to that, but for now, just assume that we just have one single asset, okay, that represents the bond market. And just know that if we go into the bond market and we buy this bond, prices will react to the bond purchase or sale, and interest rate will move in the opposite direction. So in the example I explained to you just now, right, monetary expansion means asset purchases. Asset purchases means the bond price will increase, and when bond prices increase, that's going to decrease interest rates. When there's monetary contraction, there's an asset sale. When there's a sale of bonds, prices decline. And when prices decline, the returns or interest rates must go up. So that's the fundamental mechanism in which open market operations impacts interest rates. All right, so now you know, or maybe you already know, but now everyone should know in this class how Japan conducted their quantitative easing, why that pushed their interest rates all the way to 0%, and how the U.S. also did quantitative easing in 2008, 2009, and how they pushed 2% interest rates to 0% literally within a few months. Comments, questions on how open market transactions of the central banks affects interest rates? It affects interest rates through, up to this point, just think about government debt. Okay, debt contracts, like any asset, have a price, but they also have a corresponding bond yield. Once they do asset sales or asset purchases of bonds, that will affect prices, but it's going to have a negative relationship with interest rates. So based on that chain, you can already see how central banks manipulate or change interest rates in the direction they want. So you kind of can already see where we're heading, right? We want to kind of characterize the money market in which we can visualize the change in money supply and see how that changes interest rates in the direction we just described, right? All right. If no other questions, let's just go on to visualizing this on a graph. So as you learned from last week, the key axes, right, that's related from UIP to today's class is going to be interest rates. So this is our y-axis. This is R. But it could be R star as well, right? Not only about monetary policy from the domestic country, but you can also think about monetary policy from the foreign country. But anyways, our y-axis for now is going to be nominal interest rates, and the x-axis is money supply / real money holdings. So that is either L, RY, or you can think of it as money supply. And to remind you again, the relationship between R and Y, this is negative and this is positive. So let's go ahead and characterize the relationship between nominal interest rates and real money holdings. So what is it? Is it positive or negative? Should it be downward sloping or upward sloping? Based on this graph here, given the defined axes. Downward, right? Downward sloping. Because again, negative relationship, right? I'm not very good at drawing these graphs. Okay. All right. So I'm just going to draw some arbitrary points here just to maybe help with the intuition. Very high R, low R, and very low R. All right, so let's kind of just go over again intuition. If we decide to increase money supply, that means that the central bank is going to expand their balance sheet with an asset purchase. Just think about government bonds for now. They go into the secondary market and they buy some government debt. That's going to increase prices, and as a result, decrease bond yields. And naturally, as you move from left to right, interest rates will decline. So whatever I just described characterizes this downward sloping curve, right? You can do the opposite as well. Suppose you want to decrease money supply. Think about what happens to the central bank's balance sheet. It's reducing its balance sheet. It's selling as a result, and therefore selling assets, right? Once they sell assets, bond prices will go down. Bond yields go up. And we're moving now from right to left. What that means is that nominal interest rates are going up, right? We're going along this curve. Convinced? I hope everyone's convinced. Negative relationship between R and money supply. Yes? Money demand. So again, mechanism here is money demand is changing in response to its opportunity cost, and that's captured by interest rates. That's the mechanism here. All right, so some of you may ask, why is it convex? Like, why is it curved? Well, it doesn't have to be. Every country is different. Its convexity, you can estimate if you want, but for this class, it doesn't really matter. We draw it curved because we typically assume that if there's lots of liquidity here, you have to decrease money supply a lot to change interest rates. That's just, intuition to some extent. Okay? If there's a lot of liquidity, you have to remove a lot of money to change just a little bit. But when money is really tight, you don't have to change much to change the interest rate. That's basically the intuition behind why the slope is curved this way. It doesn't have to be. It depends on what L looks like, right? We don't know what it looks like. Comments, questions? All right, so let's see what the market clearing condition looks like. Same axes. Yeah. Yep.
So is the overarching goal for this is essentially for the very on the very bottom right is to it makes borrowing very cheap for people. So borrowing, like you can borrow a lot of money at low
Yes.
rates.
Yes.
But when they're doing deflating the economy on the top left, it makes borrowing very expensive.
Yes.
Which is generally harder.
Yes. That's how you control spending, essentially. So I guess for now you can think of it as trying to control inflation, but it's a lot more than that. I guess it's primarily that now. Okay, so maybe to be relevant, right? To make this topic relevant. How do you control inflation? Well, you have to curtail people from spending. How do you curtail people from spending? You have to decrease the return from that expenditure somehow. And you can do this by increasing the return of their next best investment. That's the intuition here. Okay? If you want to go out and buy a cheeseburger, but if your next best option is to put your money in the bank and make 10%, you can imagine some people will not eat the cheeseburger, right? So they just decide to lose some weight and make some money, right? That's the intuition here. So today, that's basically what every government is doing. They want to control inflation. So you have to kind of disincentivize people from spending too much. And this incentive comes from increasing the cost of consuming those things today, right? You want people to save. You want people to put their money away and earn interest. It's the opposite, 10 years ago, okay? Over 10 years ago. We want people to spend because everyone was in a recession. But now we have some other problem here. We have inflation problems. So you want to curtail people from spending too much. You don't want prices to get out of hand. And to do that, you need to disincentivize people from spending. And that's to increase the cost of spending, right? Which is increasing the opportunity cost of that spending as captured by interest rates. Yep. So I think the bank rate nowadays in Hong Kong is like 4 to 5%. So I think you should think about putting some. People should think about putting some money in CDs now, right? It's quite good return. I don't even think. I don't know what the stock market return was in the last year, but 4 to 5% is actually pretty good. All right. More questions, comments? All right, let's look at the market clearing condition, or what it looks like visually. So let's again, same axes here, nominal interest rates on the y-axis, real money holdings on the x-axis. We have a downward sloping curve for liquidity demand, and as you all know, the central bank is the sole institution that can control the quantity of money at any point of time. So this vertical line I just drew is the so-called real money supply. We call this MS divided by P. And this is LRY. So like all your demand and supply curves, market clearing is the same thing here, right? The intersection between these two lines will determine what the equilibrium interest rate should be. So here, I will put just R here. Questions, comments on this? So So to emphasize here, P for now, let's assume that it's just something we can't change. Well, this more or less is true. Average prices, who controls prices? Well, to be honest, everyone's still studying this topic, okay? MS over P is the so-called real money supply. MS is controlled directly by the central bank. So this term here is the real money supply. It's called real because we're scaling by average prices. And solely, or just freely chosen by central bank. Central bank. So L, again, is the liquidity preference. It represents the trade-off between having cash today and interest rates, right? The level of the interest rates. Money supply is determined by the central bank, and therefore the intersection between liquidity preference, or real money demand, and real money supply will determine the equilibrium interest rate. This R, therefore, will feed directly into the UIP equation, as you will see in a few slides later. Okay, and we can easily just attach, right, the UIP graph we had last week here, and we know exactly how that's going to impact eventually the spot exchange rate. All right, let's do a very simple exercise in which we look at an increase in real national income, Y, and see how that changes the money market equilibrium. So in these kind of exercises that I will most likely ask you to do in your midterm, is you will always start with an initial equilibrium and then conduct some sort of experiment where you shift curves to see what the subsequent equilibrium variable would be. Okay, so that's what we're going to do. We're going to start with an initial equilibrium in the money market, change some curves, and then see how that changes some other variable in our axes. So we have a starting point here. We have real money supply. And we have real money demand, or our liquidity preference. And we have an increase in real national income. So remind you again, the relationship is negative here and it's positive here. So I think I mentioned last week, right, if you don't see the variable in either of the axes, in this case y, it most likely will mean that you have to shift the curve. Conversely, if you see changes in one of the axis variable, either r or in this case, I guess in this case L, then you're just moving along the curve. Okay. So in this case, we're obviously going to shift the curve, and I'll explain to you mathematically why first. So let's look at the market clearing condition first. Maybe this is most intuitive. Market clearing condition in mathematical form looks like the following. Right? Real money supply is equal to real money demand. When we increase y to y, let's say prime, this equilibrium will be distorted in such a way. Right? Y prime is larger. We know there's a positive relationship between y and liquidity preference. So increasing y will make liquidity preference larger. And so naturally, if I look at this equation here, increasing y will make L larger, and therefore this entire expression will have an inequality now, right? This is larger than this left-hand side expression now. All right, so we're out of equilibrium. How do we restore equilibrium? Step one, think about which variables you can change. So beyond the change in y, we haven't changed ms, and for now we can't change prices because who controls prices? So these two parameters are fixed, so the left-hand side can't change. So the only other parameter we have available is r. So the question I have for you is, how should r change in response to an increase in y to y prime? L is larger. We want to make it smaller now. How do we make it smaller with interest rates? Yes, we increase interest rates. So just based on this line here, you can already see that in order to restore equilibrium, interest rates must be adjusted higher, right, in order to have a market clearing condition. So actually this ms over p, whatever this point here, is kind of arbitrary. I can choose any ms over p, right? Any hypothetical ms over p along this horizontal axis and draw a vertical line. Any ms over p for any ms over p. If y is higher to y prime, increases to y prime, then r must increase as well. So the entire curve must shift upward. Doesn't matter which ms over p that you choose, the entire liquidity preference curve must shift upward. And now we'll write here liquidity preference r and y prime. Okay, y prime indicating that the new level, the higher income level than before. Okay. All right, so based on this, what is our conclusion? Our conclusion is that our new equilibrium interest rate is higher. And let's call that just r prime, okay? And I'm going to call the initial equilibrium interest rate as r naught or r0. All right, so hopefully just mathematically you are convinced that this must be true. Okay, so let's just go over it again, and then we will talk about the economic mechanism. Okay? Just the intuition, which is probably more important than the math. But I think the math is easier to convince people. So this setting, we have a change in y such that y is higher than before. And I'm going to denote y prime greater than y. Y feeds into one function here, right? The liquidity preference function. We know that L and y are positive related. So if I decide to increase y to y prime, then the market clearing condition is going to be distorted. Market clearing condition states that real money supply must equal to real money demand. If y prime is greater than y, then the entire right-hand side is going to be larger than before, and therefore we have an inequality in which real money supply is lower. Step 2 is to realize that ms and p can't be changed. I can't change these parameters. But what I can change here is r. So how should r change to offset this increase in y prime to restore market clearing? We can do this by, as someone said, increasing r to a higher value. Okay? That's the mathematical way of thinking in this equilibrium equation. The choice of ms over p is kind of arbitrary. We just chose this line here. But in fact, if I chose any point here and we have this distortion, r has to be at a higher level no matter what. Right? So the entire liquidity preference curve must shift upward, or to be as precise as possible, away from the origin. Okay? So I kind of want to emphasize it's not upward. It's upward here, but it's actually away from the origin. And I'll explain this to you at the end of today's class. Yes?
So in a real-life context, if you have an increase in GNP, so basically, is it saying like to maintain the same real money holdings, you would have to increase the return on bonds. So in a normal situation, let's say GNP of a country has increased. Would it be a combination of both, where the real money holdings would both increase and an interest rate would increase. So instead of maintaining the same real money holdings, would it be more dynamic? I'm trying to think of like the logic behind.
Okay, yeah. Let me talk about the logic here. So, yeah, let me talk about the logic first, and then you can ask your question again. So, I'm going to outline the economic intuition right now. Okay. So what's going on here? When we have an y prime greater than y, we have households becoming essentially wealthier, richer, more income. When you're richer, you're obviously going to spend more, right? Yes, some of your savings, some of your income is going to be saved, for sure. But if we're all normal human beings, we're not going to put all our extra income into our savings. We're actually going to consume more. So what's going to happen when they're trying to consume more? Well, some households will actually convert their illiquid assets to liquid assets. Yes? If you're wealthier. So all households are trying, let's just say some, okay? I don't want to say all. Some households are trying to sell assets to raise liquid money. For example, for consumption. But it doesn't have to be. You can. Some people want to invest in riskier assets. Yes? That's also possible. What will they do? Well, how do you sell your assets, which most likely will be debt-like, let's assume it is. So they'll dump the bonds. And bond prices will decline. Which means bond yields will increase. Therefore, R increases. All right, so maybe some of you may not be convinced about dumping bond holdings. Do all households have bond holdings? Well, we're thinking about aggregate economy here. So to some extent, yes, not everyone holds bonds. You should for diversification purposes. But in aggregate, yes, when the entire economy becomes wealthier, a lot of people will move their liquid assets into liquid assets, namely money, and they will sell off assets, including bonds. When bond prices fall, bond yields rise, and as a result, we have interest rates rising. When there's a so-called income shock, right? So the key mechanism, I think you were asking, is from this asset sale. That's the mechanism here. There's an asset sale because they want to consume more today, and they're converting some of their assets from illiquid to cash, and using that cash to buy things. Yeah.
Would an aspect of this be that when GNP rises, people have more money, therefore they're more risk adverse? So an aspect of it could be they're converting to liquidity to spend, or they are changing to maybe the stock market to look for more risky.
Both is possible. Risk changes and risk aversion, I don't know. I have to think about that. That's another layer here. But I don't think you need that assumption to have this effect here. Yeah. Yeah, unless they are, I don't know, if they're risk loving, I'm not sure, but that's like an aberration. That's kind of a deviation from normal. So I don't know, but I don't think you need that assumption about risk aversion. Okay, comments, questions? So before we take a break, let me just summarize what we've basically done. We did basically an experiment, right? And we introduced a shock to our money market model. And we saw that this shock coming from income will distort liquidity demand, right? When people are wealthier, they're going to spend more. That means there's going to be some degree of conversion from illiquid assets and to cash. And this conversion of liquid assets will include subsume bonds in their portfolio. And this dumping of bonds will decrease prices, increase yields, and as a result, we have interest rates rising. And we'll see after the break, we'll see that increase in interest rates will affect UIP somehow, right? We all kind of know already. When you have R increasing, domestic returns are larger, and so forth, you just do all that. You do all that stuff again, and you can identify the equilibrium. Now the equilibrium spot exchange rate as a result of this income shock. I will now introduce to you two types of analysis that we can do with this kind of money market equilibrium model along with UIP. So as I mentioned already, the next step is to combine these two models, UIP and money market equilibrium. But we're going to analyze monetary policy and with these two distinctions, two types of scenarios. You can think of it as scenario analysis. We're going to make a distinction between short and long-term effects of certain central bank actions. And the key variable that differentiates between short-term and long-term is going to come from whether or not we allow prices to change. Okay? In macroeconomics, price not changing to any other parameter in a model means that prices are so-called sticky. So maybe you've heard of this in your macro class, but that's the difference between short-term and long-term. The second type of analysis, scenario analysis, is the difference between what's called temporary versus permanent change in monetary policy, money supply. So the difference between temporary and permanent is temporary actions by the central bank will be undone before we get into what's called the long run situation. Okay, so long run just means expectations will matter. So any temporary change in money supply, for example, will be undone before we go to the long run, in which therefore the expectations of the spot exchange rate won't be affected. Conversely, permanent changes means any sort of action by the central bank will persist into the future. So if anything that persists indefinitely into the future, expectations about anything, particularly about the spot exchange rate, must change as well. So we're gonna do two types of scenario analysis: short versus long term. Short term meaning prices are sticky, don't respond to money supply changes. Long term means that all prices will change in response to money supply changes. Okay, one for one. Temporary and permanent means that any change by the central bank, its action will be undone before we get to the future or the long-term area. Permanent change is that any action today will persist indefinitely into the future, and therefore expectations will change. So short term, fix P, and temporary means fix E hat E. Otherwise, E hat E will change and P will change. Okay? All right, so I kind of already said this. Short term means that prices are sticky. Sticky just means that it's constant. It doesn't respond to any changes in money supply. And therefore, based on this model, you can easily see that we actually require prices to be fixed in order to have a meaningful material impact from changes in money supply. Right? You can see that. So let me remind you what that looks like. MS over P, right? If P changes one for one with changes in money supply, the real money supply curve will not respond, right? So so what that means is that if prices respond to money supply, then any monetary interventions doesn't matter. Monetary policy is totally irrelevant. It's only because of sticky prices does money supply have any material impact on interest rates. Long term means that prices are fully flexible. So we allow prices to slowly increase to the same level of increase in money supply, change in money supply, and therefore, in the long run, monetary policy will have no real impact, right, as I just described. So let's go through an example in which we have an increase in money supply under sticky prices. So now this is our initial step into understanding monetary policy, how it changes interest rates, and what this looks like visually through this graph that we've created in the beginning of this class. So again, downward sloping relationship between liquidity preference and interest rates, or negative relationship. And let's have a starting equilibrium arbitrarily at this point. So let's call this MS over P. And let's denote this as LRY. So what has happened based on this statement here, increase in real money supply under sticky prices. Sticky prices mean P is fixed. P is fixed. And now we have a new level of money supply that's greater than the original level. And I'm going to use MS prime to denote the new level. Can somebody tell me what's going to happen in this graph when MS increases to MS prime? Which way should the money supply curve shift, left or right? This is the origin, and so moving away from the origin in this chart means increasing. So if we have increase in MS prime, that means MS over P is also increasing and therefore moving to the right. So just by using this visual tool, you can already easily identify which direction interest rates should move without really understanding the economic mechanisms. But we will walk through the mechanisms step by step. So we had a starting equilibrium. Let's call that our naught, right? Our starting equilibrium interest rates. And because we increase money supply, we are moving along the curve. And we will end up at this new interest rate equilibrium level. Okay? So visually, it's very simple. We simply move the money supply curve, allow market to clear, real money supply equals real money demand. We identified a lower interest rate, and now our next step is to try to understand what's going on. So as I mentioned earlier, to conduct monetary expansion or increasing money supply, the central bank has to conduct open market operations by buying assets. How to do that? They give themselves a loan. They print money. Okay, so print, central bank prints money. They use that money to buy bonds. That will increase bond prices and therefore decrease bond yields. And because everything in the economy is benchmarked to government bonds, we should expect interest rates to also decrease. Yes? So we can also see this from a mathematical perspective. MS over P, MS prime over P is now greater than L R Y. Assume we can't change P because P is fixed. Assume we don't change Y. The nature of the economy, national income doesn't change. So the only free parameter we have at hand is R. R must move in a direction that offsets this increase in MS over P. And to do that, L must increase as well. L can only increase if R decreases, because there's a negative relationship between L and R. So here we must have R decrease so that L can be increase to the level it was before that clears the market, right? And this is exactly what we see here, right? We see R not decreasing to R prime. Yeah, clear? So maybe walk through again what's happening. So let's do the math first. MS increases to MS prime. MS prime over P is increasing because P is assumed fixed. We have sticky prices in the so-called short run. With sticky prices, the real money supply curve, which is the vertical line here, must shift to the right because moving away from the origin is increasing in value. So MS over P increases. We are moving along the liquidity preference curve. And based on the math, R must move in a direction that allows this equation to maintain parity, equality. So MS prime over P is greater. So we need to change R. That increases L to restore equality. R, therefore, must decrease so that L increases, because L and R have a negative relationship. So that's the math. Negative and positive. Right? The economics. The economics is, in order to change interest rates, the central bank must do some asset purchases. The central bank conducts open market operations. It prints money, and buys assets, expands its balance sheet. In doing so, they will put upward pressure on bond prices. Bond prices increase, mechanically decreases bond yields, because all interest rates, as you can imagine, are benchmarked to U.S. or the government security bond yield. Interest rates will decrease. Now let's think about flexible prices. So let me just write out really quickly, or draw out really quickly, the starting equilibrium. Can someone tell me what happens in this graph when we have flexible prices and an increase in money supply?
No change.
Correct. No change. When prices reflect changes in money supply one for one, there is no change in the real supply curve. As a result, monetary policy is ineffectual in this scenario. It is only through sticky prices can monetary policy have impact when we increase money supply in such a fashion, like in a one stepwise increase, right? Just a one-shot increase. All right, so this is just a little bit more institutional background. The fact that central banks can essentially issue their own loans, give themselves, lend to themselves, and use that money and use that loan to buy things is called seigniorage. Okay, that term right there. Central banks across, at least the developed ones during the financial crisis, made actually a lot of money from being able to just print money and use that money to buy things. The example I typically give is during the financial crisis in 2007, 2008. As you know, that was That was when we had that mortgage MBS crisis, right? The mortgage-backed security crisis. So what the central bank had to do is they had to print money, essentially, to buy these so-called toxic assets. But the problem wasn't that these assets were not generating sufficient returns. It's because they were illiquid. They couldn't sell it. And so they were the lender of last resort, and so they just bought it up, right? They bought it up and just gave these people money. But in reality, over a long period of time, like a few years afterwards, no longer there's a liquidity crunch, and the central bank, the Federal Reserve, was able to sell off these assets at a profit. So this is all because they have this ability to just print money and just buy whatever they want. Okay. What's interesting now is that in the last few years, Japan has actually decided to print money to buy stocks. It's kind of I don't know. It's diving into new territories here. So, but this is the thing that central banks can do that no one else can do. All right. And just to remind you here again that we're not so concerned about the differentiation between monetary base and money supply. You can read the description here for the difference. But just to reiterate that there's basically two tools that that central banks can use to curtail or encourage spending, holding on to cash. They can do it by, as you know, from changing money supply, right, from buying and selling securities, government securities, or they can actually change reserve ratios. And the reason why they can just do that through reserve ratios is because of this multiplier effect from people taking some quantity of money, depositing it in another bank, banks lend it out, and so forth, and it multiplies indefinitely unless there's restrictions on how much the bank can lend out, right? That's what the reserve ratios are. Now let us go ahead and combine the money market graph with the with the FX market graph as represented by UIP. So as a reminder, we are going to just assume that UIP is true. The assumptions are true, and therefore UIP must hold. Again, that means that whenever there's a violation, it will be quickly restored by carry traders, buying or selling certain currencies that restores parity to UIP. So let's see what that looks like. So what I've done here is rotated the money market graph clockwise so that the shared axis between the UIP plot and the money market plot is now interest rates. So let's denote this as R star, E hat E minus E over E. And we all know what the graph looks like, right? For UIP, the graph is downward sloping. And because we rotated the money market graph, the curve is actually going to look like it's upward sloping, but just convince yourself that that's true. Okay. Let's go ahead and identify an initial interest rate, equilibrium interest rate, by drawing a now horizontal real money supply curve. So let's call that MS over P. And let's just draw a vertical line that cuts through both graphs. This will be our equilibrium interest rate. And at the intersection of UIP and this vertical interest rate, we will have our initial equilibrium exchange rate, call it E naught. So remind you, there's two separate equilibriums occurring in this plot now. We have UIP clearing, or holding, because of carry traders. R equals, I'm going to use a simplified equation here. And we also have the money market clearing. real money supply equals to real money demand. You can see where the FX market goes in this math, just working with one formula, right? Just plug that directly into here if you want. You can. And there's just one equation. But I think this is more compelling, right? You can see exactly the moving parts. You can see how things are restored. And you can also evaluate long run and short run movements from one point to another, which you will see soon. Okay. So let me just briefly outline how things work when we do like monetary policy changes. So suppose we have change in monetary policy, money supply will change, that will change interest rates. That's going to force UIP to violate unless carry traders come in and maximize expected profits, right? Carry trade profits by borrowing at low interest rates and lending out at high interest rates. When carry traders come in, maximize expected returns, UIP will be restored, and upon restoration, you will end up at an equilibrium, the new equilibrium spot exchange rate. So that's the sequence of steps that occurs now. Comments, questions on this setup? So summarize again what we've done. We've taken this UIP relationship, which we saw last week, right, where we plot exchange rate, the nominal exchange rate, with interest rates. So those are the two axes that was given to you. Today we looked at the money market. The money market has a shared axis, which is interest rates. The other axis is real money holdings. We've merged these two graphs by a common axis. And to do this, we need to rotate the graph that I showed in the beginning of class. And our final graph looks like this. This graph represents two equilibriums. One from the money market, in which money supply equals money demand, and the FX market as represented by UIP, in which expected carry trade profits should be 0. So let's go ahead and try to study what happens when central banks decide to conduct expansionary policy. In the short run and also in the long run. So let's analyze this simple case first. A temporary increase in domestic money supply under sticky prices. So let's just digest this title first. Temporary means that expectations about any future variable doesn't change. Temporary, so let's say it again. Temporary means that any expectations about any sort of future value, random variable, random value going forward out in the future, it does not change. Because any of that action that's taken now will be undone before we get to the future. What we want to do now is increase domestic money supply. So that means MS is going to increase. And we also have sticky prices. So P stays constant. So let's write out those setup. So temporary means no change in E hat E. Increase in domestic money supply. That means we have MS prime being greater than MS. The new level is greater. And we also have sticky prices. Sticky prices means that P is constant. All right, so that's the setup of our problem. To analyze what happens, we first have an initial equilibrium in both markets. So let me quickly draw these lines. We have a market clearing condition in the money market, MS over P. It's our starting point. And liquidity preference. And we have UIP. And we will characterize UIP as R equals R star plus E hat E minus E over E. And also to remind you that this axis here is R, or R star plus E hat E minus E over E. All right, given this setup, we have a initial equilibrium interest rate. And with that interest rate, we have, as a result, a starting point for our spot exchange rate. E. Let's just call it E naught. So what happens? Let's start with the only thing that changes is this, right? MS prime is now greater than MS, so the new level of the money supply is increased. So we will therefore have a larger real money supply. Larger means away from the axis, the origin. So that means the MS over P must shift downward. So let's move the horizontal line down to this spot here. And let's call that MS prime over P. And now we have a new equilibrium interest rate, R prime. And that intersects UIP at this point here. Just based on this graphical analysis, we can conclude that when the central bank decides to increase money supply under sticky prices, we have lower interest rates. Lower interest rates is going to actually increase E, or the domestic currency is going to depreciate. So let's walk through the math first to convince ourselves that indeed this curve has to shift. And E prime must be higher than E naught. We can see this by looking at the market clearing condition. MS prime over P is greater than L, right? When this occurs, we're no longer in equilibrium. We want this market to clear. Markets clear. If we can't change P or Y, the only thing that can change is interest rates. So interest rates have to move in a direction that offsets this increase in the left-hand side. So we have to increase L somehow. We know that L and R have a negative relationship. So decreasing R will increase L. So as a result, we have lower interest rates. Correct? All right. Now the market clearing, or the parity that must hold in equilibrium is the following, but because we have lower interest rates, domestic interest rates, UIP is therefore violated. So given that R star can't change, the only other, and E hat E doesn't change because we assume no change in E hat E, the only other parameter we can change is E. So E has to move in a direction that offsets this decrease in R, right, to R prime. So we have to make the entire right-hand side lower somehow. We can do that by allowing E to go up. Yes? So that's why we end up at here, C E prime. So mathematically walking through it, you know exactly what happens. Now the intuition, right? That's the most important. What's going on? What's going on is central banks are expanding their balance sheet. They're printing money, and they're using that money to buy assets. Buying assets will push up prices, bond prices, and therefore push down bond yields. Bond yields, therefore, will push down interest rates. So interest rates will decline to a lower level. Now, at a lower R prime, we have expected carry trade profits being positive, right? They can borrow domestic and lend out foreign deposit rates. Carry traders, given that they are risk neutral and maximize expected carry trade profits, they'll come in and do what I just said. And that requires converting their currency in such a fashion that depreciates the domestic currency. And that's exactly what we see. So let me write out economic intuition here. We have buy bonds. So print money to buy bonds. Bond prices increase, and interest rates, bond yield decreases, which means R decreases. Now on top here, we have R prime lower than R, so carry traders will will lend or borrow domestic and lend foreign, but they have to sell domestic for foreign. And that will depreciate the home currency. Good. So I've presented you two ways to analyze this. One, just mathematically, just to convince you what needs to change, right, to get the final answer, the final result. And I've presented to you the economic intuition of how we go from OMO, open market operations, to changes in the spot exchange rate. All right, comments, questions? So under this model, we don't necessarily have to only be restricted to analyzing open market operations conducted by the domestic central bank. We can also analyze what happens to the spot exchange rate by thinking about open market operations conducted by foreign central banks, right? So again, let's read the title, A Temporary Increase in Foreign Money Supply. We have MS star prime, right? Greater than MS star. Things are still temporary. So that means no change in E hat E. And prices are still sticky. So that means P constant. So let me just draw quickly the starting points, starting equilibrium. R and MSP over P, and then we have E hat E over E. Okay. So tell me what happens. Somebody tell me what happens. In this graph, okay? Of course, you can do the same analysis assuming you are the foreign country, but just in this graph from the perspective of the domestic country economy, what should happen in this graph? So the hint again is, if it's not in the graph, something has to shift, right? If the variable is not in the axis, something has to shift. So what's the variable that's going to change as a result of MS star changing in this graph? R star, right? R star has to change. So you can think about this, you can think through this here, right? So suppose pretend we're the foreign country now. If I increase MS as a foreign country, I'm going to have foreign interest rates decreasing. So if foreign country decides to conduct expansionary monetary policy, you're going to have a lower R star from the perspective of the home country, the domestic country. R star enters this graph through UIP. So something has to change in UIP. So let's walk through the math. So what's happening now is we have UIP being violated. because r star prime is greater than r star. And this will incentivize carry traders to come in, maximize expected carry trade profits. They will, in this case, borrow domestic, lend out foreign. And to do that, they have to convert domestic to foreign. That means the home currency must get they must convert stronger, right? Sorry, weaker. So if you're weaker currency, then E has to increase. Increasing E will decrease the entire expression on the right-hand side, and as a result, sorry, it's the wrong direction. Lower, it's lower. Yeah, sorry, I was confusing myself. Okay, so lower interest rates, right? Then carry traders will borrow foreign and lend out domestic. In doing so, they have to convert foreign currency to domestic currency. That means they have to sell foreign and buy domestic, and that means domestic currency is getting stronger. So E has to decrease. Yes? So another way of saying this is pick any interest rate. It doesn't have to be here. It can be anywhere along this line. As long as I have a higher R star, E must be lower than what's drawn in this graph. So the entire UIP graph here have to shift towards the origin, or down in this case. Right? It doesn't matter if I choose this R or this R or this R. For any R I choose, if I have a lower R star, I must have a lower E to compensate. So this is the new plot. So maybe I write R equals R star here, and I will write R equals R star plus prime. Okay, so our equilibrium spot exchange rate is the intersection between this chosen R, right, and UIP, and that's going to give us, let's call it E prime, and this point here is our starting point, right? Was our starting point. E naught. All right, so I just walked you through the math, so let's walk through the intuition. The intuition is the following. I won't walk through the money supply change in the foreign, right? I'll just walk you through the intuition for this part here, right? The economic mechanism is the following. We have carry traders borrowing foreign and lending domestic. They need to convert foreign to domestic, and E will decrease. And then the mechanisms, economic mechanisms for increasing money supply for the foreign country is the same as the previous slide. Comments, questions? So a good exercise is to do the opposite, right? Do the opposite, monetary contraction for foreign, domestic, see what happens, convince yourself that's true, think through the economic intuition, think through the math, and just convince yourself that this must be true visually. All right, so this is just a summary slide of what we did. What we did is we conducted two essentially scenario analysis. We did monetary expansion from the domestic central bank, and we did monetary expansion for the foreign central bank. You get two opposite effects, right? Which, as you should expect, when we have domestic monetary expansion, we have the domestic currency depreciating, right? We have E increasing. But when we have foreign central banks conducting expansionary monetary policy, we have the domestic currency getting stronger, right? It makes sense. They're injecting their more quantity of their currency, foreign currency. So naturally, relatively speaking, domestic currency is gaining stronger. So what we're going to do next is try to think about relaxing this assumption of P being constant. All right. So we're going to, in order to have a material effect, we actually have to combine P being flexible as well as a permanent change in monetary policy. Because as you know, when you have temporary monetary policy plus flexible P, nothing happens, right? Monetary policy is ineffectual. So you have to have two things to have sort of long-term inferences. You need a permanent change in monetary policy as well as flexible prices to see what happens in the long term. So let me give you a preview of what to expect, and I'm going to give you a more real tangible quantity goods and services explanation of what's going on. What you should conclude from the long-term analysis, from transitioning from short-term to long-term, is that in the long run, the spot exchange rate, the change in the spot exchange rate, should trace or follow the change in P. And this is intuitive in two perspectives. From like a finance nominal perspective, yeah, obviously if you increase money supply, in the long run, all price levels should chase the quantity of money. So all price levels should rise. But you can also think of it from a real economy perspective. So I'm just going to read this explanation to you. So given any exchange rate, higher P makes exports relatively expensive for foreigners and imports relatively inexpensive for domestic residents. So this is just calling back the definition of the real exchange rate, where we have higher P disincentivizing people from consuming domestic goods and services and opting for exports. So in doing so, they have to sell the domestic currency for foreign currency or buy foreign currency, which will make foreign currency stronger and E weaker. So as we have higher prices, E therefore will obviously increase as well, right? That's kind of the real mechanism rather than the monetary explanation. So the monetary explanation is you increase money supply, all prices should chase the elevated level of money supply. But there's a real side of the argument as well, right? You have higher prices. Higher prices mean people will prefer to import. Importing means people will sell domestic currency for foreign currency. That's going to weaken domestic currency, and therefore, naturally, E, the level of E should chase price levels, domestic price levels, in the long run. Okay, so I'll show you what that looks like graphically. Okay, so this is the summary I want to show you. So let me just show you first, and you can read the slide afterwards. So let's, as usual, let's have a starting point. Let's assume that we are already at an equilibrium somewhere. And then after that, let's read the title, okay? And then we'll digest what should be done. So we have UIP here. We have liquidity demand. Okay. Let's label the axis R star plus E hat E. And assume that we have money supply set here, real money supply. MS over P. That will clear the markets at this intersection, and therefore we will have a equilibrium interest rate that clears here, and therefore we have a starting spot rate here. Let's decompose the title now. We have a permanent increase in domestic money supply. So permanent tells us that expectations will change. And based on this real side of the explanation, people's expectations should be that E is going to be elevated, right? So E hat E is going to be moving upward. So given a permanent increase in domestic money supply and therefore higher future long-run price levels, and as a result also exchange rate levels, E hat E prime will be greater than E hat E, right? The new level of expectations will be higher than before. That's what that means for the spot exchange rate. Increase in domestic money supply, that just means that we have also here MS prime is greater than MS. And so for now, let's stick with sticky prices, but we can relax that soon. So sticky prices mean P is constant. So let's just shift the curves or see what happens, condition by condition. So the easiest condition that we've seen before should be this change in money supply. So let's see what happens. Increase in MSP means that increase in MS means that MS over P is going to expand outward away from the origin because P is held constant in the short run. It's sticky in the short run. So we have the downward shift of the real money supply curve. And let's just assume that it's here. Let's label this MS star over P. And we will have a new equilibrium R. Sorry, it's going to be a little bit slanted. Let's call that R prime. All right, so that's the first condition. Second condition. Expectations have changed today. What does that mean? Well, it firstly means that UIP is no longer holding, right? So let's go ahead and look at the formula just to convince ourselves that what must change is because of the math. So what we have is now R being less than R star plus now the higher level of E hat E prime minus E over E. All right, so given this inequality now, carry traders will come in. Looks like they will borrow domestic, lend to, and lend their money and deposit their money in foreign bank accounts. To restore equilibrium, E must change in a way that reduces the entire value of the right-hand side, and that can only happen if E increases, right? Increasing E will decrease the entire fraction, and therefore the entire expression will be lower. So what I've just said graphically means that if we fix any R, as long as we have higher expectations about the future spot exchange rate, E must also be higher. So the entire UIP curve must shift upward. Right? Again, the argument is pick any R, so the entire curve shifts up. Let's just call this one E hat E prime minus E over E. And this is the old curve, right? The old curve is when we have E hat E by itself. So the final market clearing or equilibrium exchange rate is the intersection of this new UIP curve along with R prime here. And this is only achieved because we have sticky prices, right? Because we have real effect coming from monetary policy expansion, expansion. And because of this, we have lower interest rates, and therefore we intersect at this point here. So let's call that E prime. Okay, so let's now analyze this in the so-called long run, in which the sticky price condition no longer holds. So what happens next? Let's think about the money market first. So what happens in the money market as we move from short run to long run? That is letting prices to move one for one for an increase in money supply. So we're here now. Sorry, should be prime. Sorry, this should be a. We're here now. If P is allowed to increase as much as MS has increased, then this curve should actually return back to its original level, right? Because just imagine, we multiply this term by alpha. That's how we increase it. So prices increase by the same percentage point. Those two numbers cancel out. So we're back where we started. So as time evolves from short term to long term, we should see this equilibrium interest rate slowly move back to its starting point here. Yes? Because we allow prices to be flexible, prices now respond to money supply changes, and we assume that it moves one for one. Yes? Moving one for one means that the effects of monetary expansion is no longer can transpire, right? All effects are undone. Interest rates back to its normal level. However, what has persisted from the short run to the long run is E hat E prime. So UIP curve stays elevated, right? Or more outward than before. And so the long run exchange rate level is therefore here. This is E, let's call this E double prime. So what has evolved over time from short run to long run is this falling path here, right? So remember in the beginning of class I talked about the homework assignment where we see extreme volatility in the carry trade profits because of the volatility of the exchange rate? Well, here's an explanation. What you're witnessing here is an overshooting of the spot rate in the short run. You can see that we started from here, E naught. In the short run, because of sticky prices, we overshot our long run levels, right? Up to here. But as prices are allowed to reflect changes in the money supply, interest rates are back to its original level. And as a result, E prime will also progress downward as well along this new, now elevated UIP curve. And so our final long run exchange rate level will be somewhere between E naught and E prime. But compared with the starting point, we indeed see that as prices are allowed to increase and respond to increases in money supply, from E naught to E double prime, E also evolved in the same direction, right? E naught to E double prime is larger than E naught. So as price levels increase, the exchange rates also have to increase as well as we move from our starting point, our pre-shock level, the pre-monetary policy intervention level, to our long-run intervention levels. So just based on this model we have here, can allow us to create volatility, right, in exchange rates. It's because of sticky prices and monetary policy uncertainty that creates this overshooting in exchange rate levels and returning, back to its different level. Okay. Comments, questions? So maybe I will walk through the math again and walk through the intuition again. just to reiterate and make sure everyone understands, whatever I'm describing is two sides of the same coin. So let's walk through the math. So what's going on? We have two effects going on. We have money supply increasing. And we also have expectations increasing. Expectations increase because in the long run, people expect all price levels, including the price of foreign currencies, to increase. Therefore, expectations about the future spot exchange rate also must increase. Let's analyze this step by step. What happens first when we increase money supply? Assuming sticky prices, money supply MS over P must increase because P is sticky. When that occurs, we have a distortion in the equilibrium, money market equilibrium. Yes? If this is true, given that y doesn't change and p is fixed, the only other free parameter is r. R must change in the direction that restores equality or equilibrium. That's only possible if this entire expression becomes higher. This is possible if, in other words, this entire expression declines only if r decreases, right? So therefore, we observe a lower interest rate. Now, with lower interest rates, we have UIP violated, right? I forgot to write the prime, so let me write the prime. We have UIP being violated. This is unacceptable, right? So to restore UIP, something must change in the right-hand side to decrease the entire expression on the right-hand side. How do you do that? It looks like you can increase E. Yes? So we increase E as a result. But the increasing E is actually much more amplified because another thing occurred, right? We have expectations about the future spot exchange rate also increasing. So E has to respond more because we have an elevated E hat E. So we have the final E increasing to E prime. OK? All right, the economics. The economics is we have central banks buying assets by printing money. When they buy assets, they increase the asset prices, bond yields go down. And when bond yields go down, interest rates are likely to follow. Lower interest rates creates opportunities for carry traders to come in to maximize expected carry trade profits. They borrow low interest rates, domestic interest rates, and lend out at foreign interest rates. Requires currency conversion from domestic to foreign, and that's going to depreciate the domestic currency. So E is going to go up. But the decrease must be much higher than before because expectations have shift up or shift outward the UIP curve. So that's how we arrive at the so-called short-run equilibrium. So let me highlight that. This is the short run. Short run equilibrium. So I'm going to SR stands for short run. Okay. All right. So that's not the end of the story because now we're going to allow prices to be flexible. So we're going to transition from short term to long term by relaxing sticky prices and allowing prices to reflect changes in money supply. Assume price levels change one for increases in money supply. The real money supply curve, therefore, must return back to its original level. So that's why we move from this point to this point. You can see this mechanically, right? Any increase in MS prime must also be reflected in price. So this increase the same as this. Those increases will cancel out because it's a fraction. And therefore, we're back to this level here. Visually speaking, we're just moving along this curve here. And the new level is here. So this is long run. We use a different color. Let's call this green. This is long run. All right. So R is back to normal, but E hat E is still elevated in the long run. So we're still working with this curve here, and then therefore the new intersection is still elevated, but much lower than the short run. Okay. So this is our complete analysis of short run versus long run analysis, as well as now temporary and permanent analysis. So to summarize again, temporary monetary policy shocks are only possible. Monetary policy intervention is only have a material effect only if prices are sticky. If prices are not sticky, monetary policy is useless. So in the short run, you can see it can have an impact, supposing there's sticky prices. Prices don't move to anything. In the long run, you have to have changes in expectations to have a long-lasting effect when we're dealing with this one-shot kind of scenario. Right? We're only increasing money supply at just a one-shot level. What you see here in this kind of monetary policy expansion is an overshooting of the spot exchange rate because of sticky prices, right? You saw here, right? Carry traders have to close the gap by increasing E at a much higher level than in the long run. So there is an overshooting effect, consequently, from a permanent monetary expansion. Okay? In the long run, again, the key takeaway here is that as prices rise because of changes in monetary policy, E naught also has to increase to a higher level as well, just as prices have, right? It's increasing from E naught to E double prime, which, again, intuitive. It should be intuitive. Exchange rates, no different than asset prices, than goods and services. If all price levels rise, you should expect spot exchange rate to also rise. So this is, again, I just summarized this already, right? So my suggestion is just to try the reverse, right? Maybe there's undershooting. What does that look like? I'll leave that for you to do as an exercise. Yeah, what does undershooting look like? All right, so final thing I want to talk about before I summarize today's lecture is to analyze what we saw here. To analyze what we saw here, but in a timeline. Okay, I want to show all this transition of price levels and money supply and interest rates and exchange rates across time, right? Which you somewhat see, but it's kind of a cross section, right? You want to see evolution over time. So this graph here, we have the axis that's money supply. This graph here, you have the axis that's interest rates. This y-axis here is exchange rates, and the y-axis here is price levels. This graph here, I think, should be obvious what's going on, right? We have a monetary money supply, initial starting money supply, and we decide to expand monetary base. So there's a jump. Okay. Prices are flat in the beginning because we assume price levels are sticky. So what we should expect as we transition from the short run to long run, however, price levels should follow the direction in the change of money supply. So what we should see over time is price levels slowly increasing towards at least the same quantity amount in which money supply increased. Yes, that's kind of like, yeah, that's our transition from short run to long run. All right, but what about interest rates? From the previous graph, we saw that a change in money supply has a sudden drop in interest rates. Yes, but then it progressively, returns back to its normal level. So let's draw that over time. So what's happening is we see a drop, yes, but it will recover over time. So by this point here, monetary policy is undone, right? All that's left is changes in expectations. So this is kind of arbitrary. It doesn't have to match here, okay? This is an arbitrary horizontal line. As I mentioned in the previous slide, because of sticky prices, there was a overshoot, right? And then a return, right? And a slow return, right? There's an overshoot from here, E naught to E prime, and then a gradual approach to a slightly lower level, but still higher than before. And we can characterize this in a timeline by drawing a sudden spike, right? And then gradually approaching its long-run levels. So in the end, going from here to here is precisely what's going on from here to here, right? But because of sticky prices, we get this spike here. Make sense? Hopefully it corresponds more or less to what you just saw on the other slide, right? The other slide, I kind of did a cross section and I have to draw arrows to see where things are moving. But here you see a timeline of all these macro variables and financial variables, and you can see what's going on. You see a large, just a lump sum increase in money supply, which will cause interest rates to move, right? Immediately. But as price levels increase one for increase in money supply over time, monetary policy results are undone. But because of change in expectations, E still will increase to a higher level, despite having a large spike due to this, this stickiness in prices here. All right, comments, questions before I go into the summary slides? All right, cool. All right, so somebody asked me during the break about what this shift in the L curve looks like in the 3 dimensions, so that's what I'm going to do, all right? Maybe I'll show you the graph first, and then we'll talk about multivariate calculus. So here this axis is R, okay, and this axis is L, and this y-axis here, okay, you don't see it, but let me circle it for you. This term here is y. All right. So what you're seeing in the graphs today is actually this cross section, the relationship between R and L, right? This top part is UIP. This part is R and L. So negative relationship between R and L you can see, right? As you increase interest rates, then liquidity preference declines. Declining means going toward the origin. Yes, declining means going towards the origin. But because there's a positive relationship between L and Y, okay, Y, we should see in the 3rd dimension that L should increase as we increase Y. So remember, increasing means going away from the origin here. So with Y going this way, L should also move away from the origin. You can see that, right? It's actually going upward. Yes? So whenever we see an increase in Y, we're actually jumping levels here. Okay, so that's why I say it's not a up and down movement. It's away from the origin movement in a three-dimensional space. Yes? So this graph was generated from this equation here. So r to the -1, I hope you all know it just means 1 over the variable. Okay, it's a very easy variable to take the derivative of. So you can see the relationship between L and R and L and Y by simply taking the first derivative, right? Take the first derivative with respect to R, it's a negative. So you can see it's a negative relationship between the two variables. Whereas for this variable here, you take the derivative, it becomes a positive. So positive means the slope between L and Y is positive. So increasing in value when you increasing in L when you increase Y, decreasing in L when you decrease R. All right, so that's if you want to recreate these graphs in a computer, you can use that functional form. The reason why I use this functional form because it looks like the forms in the textbook. All right, so let me summarize the takeaways from today's lecture. So what I've introduced to you is basically another set of equations. The money market equilibrium is called the money market equilibrium because we're trying to understand what the aggregate money supply should be in the overall economy. That's determined by two parts. One is the money supply that's created by the central bank, and also money demand, real money demand. That's demand side from the overall economy. Okay, it takes money demand is represented by the variable L. It takes two parameters. It's a function of two parameters. R for interest rates, which is the opportunity cost of holding on to cash. Remember, opportunity cost means your next best alternative investment or return. So if you have higher R, you're less likely to consume and buy things today. You're more likely to save. So there's a negative relationship between R and L. For Y, it's the opposite. When you have more real income, you're more productive. You're more likely to consume more when you're more productive. Okay. If suddenly tomorrow you're a movie star, you're definitely going to spend a lot more. Okay. And if you're going to spend a lot more, you may liquidate some of your existing long-term assets, converting from illiquid assets to more to just cash. Okay. And based on this equation, you can already see there's two channels to affect exchange rates. You can affect exchange rates through the monetary policy channel by changing MS, and you can also impact exchange rates from the Y. Right? We actually did an exercise where we changed the Y. Y, as you learned from the first week, has multiple components: C plus I plus G plus EX minus IM. We're going to do that soon. Okay, we're going to integrate the real economy into this model soon. But you can already see there is a fiscal channel. If the government, for example, the Hong Kong government decides to issue consumption vouchers, that's going to push up income, right? Push up demand. That's obviously going to have an impact on exchange rates. Yes? And we'll analyze that some other time. Okay? And final takeaway here is that we've created a model by doing the scenario analysis between long run and short run, as well as temporary versus permanent, to recreate what we see in reality. Right? In reality, exchange rates are very, very volatile sometimes. And this volatility, as you can see from this model, comes from sticky prices and monetary policy expectations. Right? You get this overshooting effect, and this more or less characterizes why at certain points in time carry traders can definitely make some money. Okay. All right, so that's all I have for you today. So